Hi, I'm Andrew from NinjaTrader, and if you're getting started with futures trading or exploring whether futures fit into your trading approach, it helps to understand exactly how futures trading works. In this video, we'll break down what futures contracts are, how a futures transaction works, the types of orders that traders use, and some of the most popular futures markets. We'll also take a closer look at contract specifications and why those details matter when you're planning trades. So, what are futures contracts? At their core, futures contracts are standardized agreements to buy or sell an underlying asset at a predetermined price at a specific date in the future. These contracts trade on regulated exchanges and cover a wide range of markets, from energy and metals to agricultural products and financial indices. Unlike traditional investing, where positions are often held long-term, futures contracts are typically used for shorter-term strategies. Futures are leveraged products, which means that traders can control larger contract values with a relatively smaller amount of capital. That leverage creates flexibility, but it also increases risk, making education and risk management essential. Futures contracts also come in different sizes. Alongside standard contracts, many markets offer micro contracts, which represent smaller portions of the underlying asset and can make futures more accessible for newer traders. A futures transaction takes place when two parties agree to the terms of a contract. One trader agrees to buy the contract, that's known as going long, while another agrees to sell or go short. These trades are facilitated by exchanges and cleared through a centralized clearinghouse, which helps to ensure that both sides of the trade are honored. Each futures contract has a set expiration date, but most retail traders do not hold positions until expiration. Instead, they close their positions before that date by placing an opposite trade. So, for example, if a trader buys a gold futures contract expecting prices to rise, they can later sell that contract to close the position. Any profit or loss is based on the price difference between entry and exit, not on taking delivery of physical gold. This structure allows traders to focus on price movement rather than the ownership of the underlying asset. Understanding order types is a key part of learning how to trade futures. A market order executes immediately at the best available price. A limit order executes only at a specified price or better, giving traders more control over entry and exit levels. A stop-loss order closes a position once a predefined price is reached, often used to help manage downside risk. A take-profit order automatically exits a position once a profit target is hit. And an OCO, or one cancels the other order, links a stop-loss and a take-profit order so that triggering one cancels the other. These tools help traders stay disciplined, especially in fast-moving markets. Futures contracts are available across a wide range of global markets. Equity index futures allow traders to track major indices like the S&P 500, NASDAQ 100, and Dow Jones through E-mini and micro E-mini contracts. Energy futures include markets like crude oil and natural gas, known for high liquidity and volatility. Metal futures such as gold, silver, and copper provide exposure to both precious and industrial metals. Agricultural futures cover products like corn, soybeans, and wheat, reflecting global supply and demand dynamics. And currency futures offer exposure to major global currencies relative to the US dollar. Each market behaves differently with its own volatility, margin requirements, and trading hours. To trade futures effectively, it's important to understand contract specifications, often referred to as contract specs. These details are set by the exchange and define how each contract functions. Key specs include the contract symbol, size, tick value, expiration, trading hours, and settlement method. Every futures contract is identified by a symbol. That symbol typically includes a root product code, a month code, and a year code. For example, ESM5 refers to the June 2025 E-mini S&P 500 contract. Being able to read contract symbols helps ensure you're trading the correct product and expiration month. Contract size defines how much of the underlying asset one contract represents. For example, a crude oil contract represents 1,000 barrels, while an E-mini S&P 500 contract represents $50 multiplied by the index value. Micro-contracts represent smaller portions of the same market and can be useful for managing risk or trading with smaller position sizes. Tick size is the minimum price movement a contract can make, and each tick has a specific dollar value. For example, a single tick in the E-mini S&P 500 is worth $12.50, while the micro version is worth $1.25. Understanding tick size and value helps traders estimate risk and reward more precisely. Every futures contract has an expiration date. Many traders roll their positions to the next contract month before expiration to maintain exposure and avoid delivery. Futures markets also offer extended trading hours, often nearly 24 hours during the week, but session times may vary by product. Knowing when markets are most active can improve liquidity and execution. At expiration, futures contracts settle either in cash or through physical delivery. Most retail traders avoid physical delivery by closing or rolling positions before expiration. Equity index futures are commonly cash settled, while some commodity contracts involve physical delivery. Understanding contract specifications helps traders manage risk, estimate potential profit and loss, plan around expiration, and choose markets that fit their trading goals. These details may seem technical at first, but they play a major role in building a consistent trading approach. Learning how futures contracts work is a foundational step in futures trading. By understanding transactions, order types, markets, and contract specs, you're better prepared to trade with confidence.